Hey, what's up, guys? It's Chad. We had a really interesting day in the markets today, and let me show you why. Hopefully, y'all are having a great week, but this was a rather eventful Tuesday. Not sure if you saw, but there's a big down day in the S&P 500. So, as usual, bottom right-hand corner is the S&P 500, and we had this big down day right here. Boom. Let me see if I can blow that up for you, just so you can see it a little bit better. But so we had about 1.25% drop today in the S&P 500, which is big. It's the biggest we've had all year. We've been having a really quiet market up until today. So some big news out of Washington, some big news all over the place, really. Um, but really, a lot of people have been positioning for this. So a lot of big money has been a little bit shorter, and interestingly enough, retail money has been a little bit longer than it has been. So the positioning kind of was looking for something like this to happen. Um, on the flip side, very interesting here in the top right-hand corner of your screen, we have the TLT. This is our long-term bond index. So we had a big jump in bonds today. So yields fell really significantly today. And that's interesting that it's very correlated again. So um, a lot of my systems have been talking right around here someplace, started hedging. Um, and then today we got this signal to go actually long bonds as opposed to stocks. So we've been long stocks for this whole time, although in and out of hedges. So it looked like we were fading around here, and boom. And now we switch over to bonds, which is interesting because a lot of times what you'll see is with these pennants, these like flags, you'll see a breakout here and then a move back to the peak, and then sometimes you'll get a move back down here. But it's pretty unreliable, actually. So a lot of times you will get sort of a fake breakout here and then a move upward, which looks like that's possible. You see the volume here isn't huge. We had bigger volume right here, actually, and bigger volume here. But it's a decent volume update for the TLT. So it's possible, but we're right about back in this range where we were hanging out. So it kind of depends on what we see, but I'll probably go by my models and go along the TLT. So we shall see how that works out. Also interesting, we were talking about crude oil for a long time being this upward pennant like this, so flat on the top and upward on the bottom, upward movement. And we saw this breakout and big dip to the downside. So we're still low. People keep talking about oil today being down, but really the big move was last week and the week before. We had this huge move down on really big volume, so very significant. And last time we had oil go down, the market went down with it. So we saw a sell-off a year and a half or 2 years ago, right when oil went all the way down to 25, I think, all the way down into the mid-20s. And then the other interesting thing is that we've talked about a few times is gold. So we've had a long downtrend in gold that ended up, so there's a GLD, the gold ETF. So the gold ETF hit a low of 107, and then it's been coming up ever since. Had a pullback down to 115. But if you look at the moving averages, the 50-day has started moving back up towards the 200-day. So the 200-day is pretty well flat. It's super flat. So it still remains to be seen, really, if gold retraces to the 107 level before it starts a real true rise. But for now, it doesn't look like it. There's going to be a little bit of resistance right here at 120. A lot of things confluent right at the 120 level, including the 200-day moving average. So I'm not looking for a ton of run on this move. Really, the move was back here last week with that big move up is when you would have had to have it. And so the same thing goes for bonds too. So we reached 116.50, which was really close to the lows back in 2016, and sort of made a double bottom. So if you're going to buy into bonds, that would have been a good time to do it. That was about the time when my S&P/TLT switching system went to hedging here. So it didn't go to full-time bonds. So I wasn't expecting a huge move back then, but now that it's moved to full-time bonds, we could actually see a decent move up. But we're right at this inflection point, so it's really hard to say. Anyway, I guess we have a systems for a reason, and we follow it. So that's it for today. We're 3/4 of the way through March, almost going to get to a new set of earnings in April. So for earnings this year, just to recap, earnings have been okay, but and the growth that the earnings were projected at was up. We pulled back. Q1 earnings were projected to be up by 12%, which is huge. It's huge. We haven't seen that kind of increase in earnings estimates for, I think, since 2009, which is crazy. But the estimates pulled back as well because we've had a lot of earnings guide downs. So when the companies give their earnings, they guide for the rest of the year. So they're guiding down, which could be bad. But for now, what that means for us, so I have several hedging systems. So this is one of them, right? So I start to hedge here. This is a short-term hedging system. I have long-term hedging systems, which you can go on Amazon and check out the book, Hedging Your Investments by Chad Stocks, of course. I just put it out, actually. So check it out. We go through all different types of hedging systems and strategies, and we sort of settle on a couple, and we go through a couple long-term hedging systems that work really well. And neither of those have triggered. So earnings estimates are still positive. If you go on FactSet.com, that's probably the easiest place to find earnings estimates for the S&P 500. So S&P 500 earning estimates are still up year over year. So that's great. So, and the other thing is, we're still way above the 200-day moving average. So a really easy way to hedge is to start hedging when you go below the 200-day moving average. And the reason I hedge is so I'm not trading in and out of my portfolio too much and spending a lot of money on commissions and whatnot. So I like to hedge instead. And so right now we're not in a position to hedge. So if we go down over the next week or two or month, 5 to 10% and stay over the 200-day moving average, then it's probably going to be a buying opportunity, and it probably is. So the next support level is right around 2,300, and I'd probably buy that. Everything seems to be moving forward. The Fed is enthusiastic about our economy. There will be some rate rises. The other thing to look out for is, on average, roughly 2 years after the Fed starts raising rates, then we'll start looking at the possibility of a bear market. But we're far from there as well. So buy the dips, as will I, and we'll see how it goes. All right. Well, hopefully all is well out there, and subscribe down below. Feel free to pop over to chadstocks.com and subscribe to my email newsletter. or also go to Amazon and check out my new book, Hedging Your Investments. All right, guys, have a great week. Talk to you later. Bye-bye.